I wanted to give an update on what's been going on in the BDC sector, as I know some of my viewers are concerned about how well these companies are going to hold up in our falling interest rate environment. On Wednesday, the Federal Reserve announced another interest rate cut of 25 basis points, which the markets had already bet on happening. If you're a seasoned BDC investor, you know that interest rate cuts result in less income being generated for BDCs, particularly those that hold a large amount of floating rate debt. And since most BDCs hold an overwhelming amount of floating rate debt, there are concerns that this sector could see widespread dividend cuts ahead. Let's go ahead and take a look at what's been happening with BDCs over the past month. To start things off, a company in this sector was hit with a dividend cut. And it was a bit of a surprise to their shareholders because this company was still covering their distributions with their net investment income. Gladstone Capital, ticker GLAD, reduced their dividend from 16.5 cents to 15 cents per share. It's not an earth-shattering cut, but it's still a cut nonetheless. It looks like GLAD may have done this out of precaution in anticipation of harder times ahead. They didn't have a great track record though. It's a BDC that's been through several dividend cuts in the past, and I'm not a shareholder of this company. But this dividend cut made investors panic about what other BDCs were going to do. Would other companies follow suit and start cutting their dividends just out of precaution? In the past couple of days, we've seen a few other BDCs report their earnings, including two major powerhouses in this sector. The first of those being Ares Capital, the largest BDC in the sector. In the days leading up to Ares announcing their latest earnings, there were a number of negative articles and news stories being published, warning investors about the negative impact of our interest rate cut that we had in September. This particular article on Seeking Alpha announced that Ares Capital's Q3 earnings were estimated to take a hit. But on Tuesday, Ares announced that they had earned 50 cents per share in net investment income, which was the exact same amount as their previous quarter. It did go down just slightly, but the interest rate cut that we had, at least so far, hasn't had much of an impact on this company. As I've discussed in previous videos, when interest rate cuts happen, BDCs don't just sit there and do nothing about it. They have strategies to combat falling income on their floating rate loans, and Ares Capital is doing just that. One of the biggest things going on is that more companies have been coming to Ares and BDCs in general who are looking to do business now that interest rates are lower and borrowing is now a little cheaper. The same day they released their earnings, they also announced their quarterly dividend, which was the exact same as their previous quarter. These two announcements reversed course on their falling share price, and their stock has been climbing back upward. And also, their net asset value grew by a good amount, which is another really good thing and pretty impressive given the environment. So clearly no alarms are going off for Ares Capital, at least at this moment, and they didn't cut their dividend out of precaution. It is still very early, and there are likely more interest rate cuts coming into next year. But so far, this company is handling things well. The second powerhouse in this sector that released their earnings was Hercules Capital. They released their earnings after market close on October 30th, but even before that, they released some really positive news. 2 days before their earnings announcement, they declared their dividend. Just like Ares Capital, Hercules kept their quarterly dividend at the same rate as their previous distribution. So again, no dividend cut out of precaution or need, and Hercules Capital actually holds a lot more floating rate debt than Ares Capital. But what's even more significant is that Hercules issued a special dividend on top of their regular quarterly distribution. They announced a supplemental dividend of 7 cents per share, which is the same as their previous quarter. This is a really great sign. Special dividends aren't required. They're bonuses that they willingly choose to give their shareholders. No company cuts their dividend while still paying a supplemental dividend. It's good to think of these supplemental dividends as a buffer. If dividend coverage gets worse, then BDCs that pay special dividends will always reduce these first before cutting their normal distribution if that's needed. And so far at least, Hercules hasn't felt the need to eliminate or even lower their special dividend. According to their Q3 results, this company reported net investment income of $88.6 million. This was a drop from their previous quarter, which was $88.7 million. In other words, just like Ares Capital, there was a tiny drop in net investment income, but it was very small. This resulted in NII on a per-share basis being 49 cents. This translates into their regular dividend being 122% covered. Again, this is just a tiny bit lower than their previous quarter, and it's so small that it's not even worth being concerned about at this point. Their earnings spillover did grow massively this quarter though, which is another big positive, and their NAV also saw a really good amount of growth. So this is all looking good so far. Finally, one more BDC that didn't announce their earnings, but they did announce some good news on October 30th was Fidus Investment. Now, I've never discussed this company before, but I'd say they're pretty solid. They rank right around the middle of the sector when it comes to market cap. But they have a really good track record of special dividends despite going through a pretty large cut during COVID. This company announced their typical quarterly dividend amount, again with no cut, but they also paid a special dividend, which happened to be their biggest special dividend of the year. So again, another really good sign from a BDC. I should also mention that Capital Southwest and Main Street Capital provided preliminary results. This isn't very common, but some companies will make a press release announcing what they anticipate their next earnings will be, always in a range. And for both of these companies, their earnings will be similar to Ares and Hercules, very typical with nothing too dramatic. So overall, we can see that things are still looking good early in this lower rate environment. In the next couple of weeks, we're going to see even more BDCs announce their financial results, including Capital Southwest, Sixth Street Specialty Lending, and Blue Owl Capital. What we just saw with Hercules and with Ares Capital is that these companies that are going to be reporting their earnings in the weeks ahead should hopefully be an indication that things aren't going to be too bad. And these people claiming that Armageddon is going to be happening this quarter in the BDC sector were being too dramatic. It's still possible we will see dividend cuts at some point because, again, it's still too early. But these companies are making the right moves right now to try and combat that. I also want to say this. Based on the conversations I've been having with a number of people, it's pretty clear to me that some of you are too heavily invested in the BDC sector or too heavily invested into one or a couple of particular BDCs. If this season of earnings is really stressing you out, then that might be a pretty good sign that you have too much invested in any single business development company. With the exception of Ares Capital and Main Street Capital, the majority of my BDCs make up less than 5% of my portfolio each. BXSL is only 0.8% of my dividend portfolio. So if you're really anxious about one single BDC, I would recommend diversifying your portfolio some more. I've said in previous videos that the Federal Reserve is going to be very slow in cutting interest rates, and that's what they're doing right now. Just slashing them in large amounts would cause a lot of chaos, and they know that. Stocks did fall on Wednesday and Thursday because Jerome Powell indicated that they might not be as aggressive at cutting rates as they initially thought. If that happens, then that will soften the blow for these companies. So let me know what you guys think. Hopefully these results will make people feel a little better about this sector. But with that being said, that's going to conclude today's video. If you'd like to connect with me and see what's inside of my own high-yielding dividend portfolio, then feel free to check me out over on Patreon. You'll be notified when I make trades, and you'll get access to our Discord with other high-yielding investors. Thanks again for watching. Please be sure to like this video and subscribe if you want more high-yielding investment content. Thanks again for watching, and I hope you all have a great day.